Retail sales bounced back in July. Welcome to Market Insight. I'm Ludovica Brignola. British retail sales bounced back in July after an unusually cool and wet June had kept shoppers away, weighing on broader economic growth. We had another strong quarterly GDP print in the UK and inflation picked up, but by less than expected. What does all of this tell us about the state of the UK economy? Well, to help answer all that and more, I'm joined by Chris Turner, Head of Research at ING. Thank you very much for being with us today. Right, so we saw retail sales bouncing back today. What's your take on that? But also, how healthy do you think the UK economy is?
Yeah, no, it's a really good question. And I think sort of helping retail sales has definitely been the general drop in inflation and wages kind of picking up over the last couple of years. So this real wage growth story is a sort of complete reversal of that kind of cost of living crisis story that really dominated the headlines last year and hurt everyone. So we've got these sort of tailwinds now, these sort of more positive real wages that are really starting to show up in the consumption figures. And now really on a year-on-year basis, we're looking for the first sort of gains really since the first half of 2022.
Right, interesting. And GDP figures were also decent. Yesterday, CPI picked up, but by less than expected earlier this week. And where does this leave the Bank of England in its cutting cycle at this point?
Yeah, I think we would say that the Bank of England is pretty much like the Fed. The Bank of England's already started. We think the Fed will start in September. But the idea that rates up here at sort of 5.5% or 5.25% are far too restrictive for an economy growing at, say, 1% or 1.5%. So I think they're slowly coming to the conclusion, as we saw in kind of August, and we expect further rate cuts later this year, that those rates are too high and that they can be taken down in an orderly manner. And at the moment, the market is pricing just under 2 further rate cuts from the Bank of England this year.
Right, so now let's take a look at broader Europe because we have PMIs coming out next week for Europe and the UK. And I think we can say that manufacturing as a whole has been the real drag here. Do you expect it to stabilise or to bounce? What's behind that? What's happened to manufacturing in Europe?
Yeah, no, there's weak Chinese demand is a big story, and it's impacting different economies differently. So the more sort of manufacturing heavy economies, places like Germany are really kind of suffering. So our European economist, Carsten Brzezinski, has been talking about Germany being the sick man of Europe. And I think that's still the issue. So I think the manufacturing side is still going to stay weak. We've been noticing as well that shipping costs have started to pick up again from stress in the Red Sea. So I think inventories are kind of relatively high as well, and order books kind of weak. So we're not looking for any sort of quick pickup here. But again, real wages, though, consumption can be the side of the economy that can actually keep growth supported.
Right. And it's interesting because you wrote your 3 market scenarios, right, for different asset classes after the presidential elections later this year. Surely very different outcomes for what concerns the dollar and commodities as well, whether there will be a, as you say, Trump clean sweep or a Harris presidency. Why? And would Trump like a strong dollar after all?
Yeah, that's a big debate in financial markets at the moment, in that his policies, particularly if he gets a clean sweep, which will be loose fiscal policy, extending the tax cuts, they're going to drive economic growth, and they probably would see the Federal Reserve's, the target rate, the policy rate, end up higher than it would have been otherwise. So a clean sweep, I think, gives a lot of domestic momentum and is positive for the dollar. But we have seen Donald Trump saying that he thinks the Japanese yen and Chinese yuan are undervalued. He may not like the strong dollar, but I think most analysts like myself conclude that the market will take the dollar stronger. I think the risk would be if the US economy disappointed and he was more desperate for sources of growth, then he might turn a little bit more to sort of looking for a weaker dollar. But if the economy is growing quite well, it's quite hard to drive the dollar weaker under that scenario.
Right. And what about the central bank then? I mean, the Fed might keep rates highest in the event of a Trump victory with a Harris presidency. The prediction is for more muted rise in yields. Why is that?
Yeah, so the same thing really. I mean, as I said, so domestic demand will be stronger under Donald Trump with tax cuts. What we're seeing and what we expect to see with a Democratic win and Democratic Congress, still constrained kind of Congress, would be a little bit more fiscal consolidation actually, and that idea of like tighter fiscal policy would mean that interest rates would be a little bit looser, and for exchange rates, that combination of tighter fiscal policy and looser monetary policy, that's a more bearish scenario for the dollar.
Very, very interesting analysis. Chris Turner, Head of Research at ING. Thank you very much for being with us today. Right, and that's your Market Insight. Don't forget you can watch more videos on Reuters.com.